Hey guys, girls. Just got some questions here. It's a session started. It has started now. So if everyone can just tune in and yeah, let us know that you can hear us and IT's working and all that sort of stuff. That would be tremendous. Hope everyone's having a good. What's the month now? March.
March, the 3rd of March.
3rd of March.
Yep.
Banks are calling Rose right now to do loans.
From India.
Right, yeah. Cool. So yeah, we're live. It's the 3rd of the 3rd. So
3rd of the 3rd.
Interesting numbers we've got there. But today we're going to talk a lot about financing. So last month I spoke about how to build a property portfolio in 2021, and you know, is it still possible and whatnot. And you know, it all comes down to getting the right properties, having the right strategy, and making sure that without the money we can't buy the property. So
without the equity.
Without the equity, without the servicing, without the loans, without money, you can't buy the asset. So that's why I wanted to get Rose on today. For those of you that don't know, Rose has been my personal broker for 15 years or so, maybe 16 years.
When you were 18.
Yeah, it was I'm 36 this year, so half my life.
Just about it. I've known you half of your life.
Half my life.
You make me sound like I'm old.
I feel old, so it's it's all right. But Rose, you've done probably about 80% of my loans on my
maybe
portfolio.
85.
Yeah, maybe 85.
Yeah. I agree.
You've done a lot of loans, so yeah. With it, when it comes to writing finance, understanding debt, building large property portfolios, not a lot of people, have large portfolios. Statistics show that less than 18,000 Australians have 6 or more properties. And here at B.Invested and Zinger Finance, we've probably played a part in half of those people at some point in their portfolio. Yeah. So if you want to get a large portfolio, you need to have the right strategy. I can talk all day about the strategy as how to buy them, what to look for, and all that.
And also, you need a good broker as well. Know what's out there.
You took the words out of my mouth.
Oh, sorry.
You need to have the right finance strategy.
Yes.
And, it comes down to having the right team around you. And I wouldn't have been able to build my portfolio if I didn't have your help, Rose. So thank you.
Thank you.
And last May, it was actually my birthday that Rose, my 35th birthday.
Of May.
Yeah, 18th of May was Rose's first day here. So Rose had been helping a lot of our investors on the sideline. We've got Zinger Finance, which is a company that I built maybe 9-10 years ago. And we've got very talented brokers, and some of the brokers have been here for like sort of 7 years now, and they've all come from scratch and worked their way up. And fortunate enough, last year I was able to get Rose to come on board and help head up the team. One of my goals is to build a bank one day, and you can only do cool things with good people, and you want to have the best people around you. And I thought for us to lead this team into the future, Rose is the right person. So I couldn't have got anyone better to look after the team and to lead it. So on that note, today we're going to talk about how to build a property portfolio using finance, cover some of the pitfalls, just remembering that Rose is a broker. She's not a financial advisor. And as always, I'm not a financial advisor, so none of the stuff that I'm going to say is financial advice this evening. So with it, I've got an agenda. Is there anything you want to talk about at the start today, Rose? Or?
No, we'll be guided with the slide.
Yeah, even these notes here, good. Talking about that, you've got that for later?
Yeah.
Okay, cool. Where are we? So tonight's agenda, I want to talk about what's on the screen here. Do you have the right lender for your loan? Are you paying principal and interest? What's the benefits? Some of these things I might jump in and talk from a layman's perspective here, where Rose may not be able to answer some of these questions for you guys. Yeah, but these will be the agenda of this evening's talk, and I'm going to leave the stage over to you, Rose.
Now, first thing we need to discuss about, do you have the right lender for your loan? Now, often when we do assess you, we look at like your employment. Are you self-employed or under PAYG? Now, when we look at the lender, it always like, okay, if you are self-employed, then we look at like, who are the best lender for self-employed? Only because if you look at the financial statements for those self-employed, even in the individual tax return, there may be items that they have received from the company or from what they own that may not be accessible in the bank's point of view. Some lenders, for example, if you're getting dividend from your company, some lender would not assess dividend. For example, you will receive a franking credits or franking dividends. Some lender may not include that. And there's also like for self-employed, there's also like directors fees in the directors fees, for example. This is very touching one, because if you look at director fees, some companies, some lenders out there, they will not consider it as an income. Some lenders would, some would not. So what I'm saying, when you have to have the right lender, so when we do assess your loan, some would say like, look, I want to have Commonwealth Bank, I want to have NEB. I would probably say, yes, we can do that. However, servicing on those lenders may not be possible. So the right lender for your loan is very, very important, so that moving forward, are you able to borrow more?
Yeah. And the biggest thing that I see is that we have, like, I do map sessions and strategy sessions with everyone, well, not with everyone, but on a daily basis. And when I'm chatting with people, I'm looking at their position, sometimes their portfolio looks really terrible. Sometimes it looks great. Sometimes the opportunity looks great, but sometimes it looks like they've wasted so much opportunity, and it's because they've structured it wrong. So, for example, and it might be stepping out of line here, so jump in where you feel you need to be, Rose. I see people and they've got 3 properties and they're with the second and third tier lenders, and I ask them, like, why are you with them? And they go, oh, my broker has told me, it's the best loan product, or it's the best whatever. And I'm like, your broker's lazy. Your broker hasn't thought about this at all, or they've stitched you up by putting the loan structure. I spoke to a guy last night on a map session. He may be watching this tonight. I haven't seen his name pop up in the comment box. But his position was that he had 2 properties with NAB, and his banker, one of his properties was owned completely outright, and the other one had a loan of 100%. When I asked him, like, are these properties sort of cross-collateralized? And he said, yes, they are cross-collateralized. And I was like, that's the dumbest thing I've ever seen. And I was like, there's 3 reasons why your bank will or won't will do that to you. And the first one is that they're trying to trap you, because then you're stuck.
It's difficult to get out.
The second one is because they're too lazy and they just do 1 application instead of 2 applications. And the third one is just because they don't know. So
also, let me add, say for example, right, the type of security, right, also matters. For example, you have a duplex. Now, some lenders will only lend 70%. Some lenders would lend 80%. So it does matter, because you want to maximize the equity, or you want to maximize borrowing on that property for tax benefits, obviously.
So, and if you go with, like, what I've found and what Rose finds on a daily basis, is that the banks, the big 4 banks, have more sort of better products. They're more regulated.
Yes.
You can do better things.
More competitive.
Because they're deposit-taking institutions. The loan may live out longer than the property. So there's some people which may have been able to service for a property today, but they may not service in the future to get a new loan. And you could do a thing called a security swap or a portable loan, where if you go to a non-deposit-taking institution, you can't actually carry the loan forward.
That feature is not there.
So it's not there. So it's important, like, if you, but because they're so regulated, if you start going to these second and third tier lenders, when you come back and want to go to the big 4, you can't. So it's important that you structure the the sequence of it. I think it's very important.
That's correct.
Any other comments on here, or like any of the notes here, or anything like that, or get a few notes here?
No, I've already discussed that one.
Okay, cool. This one's the one I always get asked questions on, and we can't give obviously financial advice as to do it or not. Maybe if you want to start on Rose.
So are you paying principal and interest repayments on your investment property, right? Now, it depends on your circumstances. Some can afford the principal and interest repayment. Now, if you want to maximize your tax benefits, obviously interest only may be suitable for you, and also maximizing your cash flow. Now, if you have, for example, a home loan as well as an investment loan, right? Home loan is not tax deductible. Would you rather pay more on your home loan and then just pay the minimum on the investment loan?
Mm-hmm.
So if you're also on a principal interest on your investment property, some banks would not allow you to extend that interest only period. Yeah. If you maximize like 5 years or 10 years, they might say, look, we can't do interest only for you. So that sort of thing you need to also look at, like, oh, am I able to afford principal and interest repayment?
Yeah.
So I think it's best really to review as well is, your cash flow.
I think, like, from my perspective, I always start my properties off as interest only, and then, for example, if you're building out a portfolio of 10 properties, and if you're paying an extra $50 or $100 a week, that 50 or $100 times 10 properties is $500 or $1,000 a week better cash flow that you could have today. That extra income that you're paying into your properties, you might be saving yourself 2% interest. However, you're going to go back to the bank and beg them to give you the equity back at the end of the year. The other aspect that I always look at is that if you buy a property today and it's neutral cash flow and it goes up $10 next year, $10 a year after, by year 5, if you're getting $50 a week extra income coming in, per week, and the property goes from principal and interest only to principal interest, then that extra $50 goes towards paying down that loan. So that's why I like it that way.
But the downside also, look, we may say like, okay, interest only for investment, but also please note that interest rate is higher than the principal and interest repayments.
Yeah.
So we need to weigh things, which one suits you.
Yeah, people were writing years ago a lot of hate on the internet going, oh, Nathan's going to go bankrupt when all these properties go principal and interest and all that. The reality is that my properties had already turned principal and interest with those loans, and when they turn principal and interest, the interest rate does come lower. So you need to weigh that up. Some people want to pay down their mortgage and just pay out their mortgages, which for me, I always think if I had $1 million loan on a property and I've got $1 million that comes into my bank account today, I could use that $1 million to pay out my mortgage, but ultimately that means that loan would go poof back to money heaven and it'll disappear. I'd save myself 30 grand a year, assuming it's at 3% interest, but 30 grand a year with that same $1 million that I had over here, I could use that to acquire another $1 million worth of asset, and then that might bring in the 7% yield. 7% yield being 70 grand a year, 40 grand that's sort of left over as passive income, and ultimately you would have a new asset base of an extra $1 million worth of asset, which will go up with inflation. And inflation's a big thing that, with money so cheap, it's, I don't ever want to pay it off. I wish I could get more and more money. So yeah, but we don't meet the bank's criteria today when you have, nearly 20 mil worth of debt. So it's a bit different. Next slide. Any questions, everyone, just feel free to flick them through. We'll answer them along the way. I noticed that there is a couple of questions here, so I might answer them right now. So Luke asked, hi, great content, guys, and Nath. I like the 600 grand to $6 million video. I didn't realize that video had gone live. So I did a video recently about properties that if a property used to be 200 grand in Mount Druitt in Western Sydney, now it's gone to 600 grand. Oops, getting off the screen here tonight. How could that 600 grand property turn into $6 million? So go check out the video, everyone. Glad you liked it, Luke. Can you please talk about the banks asking for full valuations at 90% versus desktop valuations at 80% LVR? Are they generally more favourable with desktop revaluations? I might answer that just to start off with and then hand over to you. But generally, if you are using mortgage insurance, so if you're going to the bank and getting an 80% loan, you don't need to pay mortgage insurance. If you go in and get a 90% loan, then you fall into mortgage insurance territory. If you're doing business with the bank and you're applying for a loan, the bank will go, okay, cool, we'll give you the loan or we won't give you a loan. If you say, I'm going to add mortgage insurance, then suddenly the mortgage insurer needs to come in and assess the deal, and they will add extra criteria. One of them being that they want a full valuation, you can't pull out equity quick enough, and it really limits your growth. So in that circumstance, if you're using as a higher LVR than 80%, then you're going to fall into some more restrictions, and they're very, very conservative. So when you send out a full valuation versus a desktop valuation, sometimes they are higher with a full valuation, sometimes they are lower with a full valuation. So it's a hit and miss, because sending out a valuer to the property, they can see if you've done a renovation to the property or anything like that. However, using desktop valuation, there is statistical data that they use, but the valuer will add their own opinion as well. So many times over the years, I've got a full valuation back and I'm like, wow, the valuer has valued my property at this, and it's been very good. And sometimes, I get the valuation back and I'm like, where's the valuer? If I need to find out, I need to find the valuer because this is wrong. So it's a bit of a hit and miss whether it's full valuation or desktop valuations. I guess if you're going to the desktop valuation, you can always go to a full valuation. But
yeah. Sometimes we don't really have a choice, because when we do upfront valuation, the system would say, okay, this is a desktop, this is a full valuation. However, we can always ask for full val if you feel like your property has been renovated and there are some addition that may add value to that property. We can always ask for full val. But sometimes we use desktop because when you do full val, it may take time to arrange with the tenants and for them to write the report, so it could take time. Desktop valuation is instant.
Yeah, and it all comes down ultimately down to the bank as to what they will allow. They might request a full valuation, they may request a desktop valuation.
Or curbside.
Yeah, or curbside, which is they don't get out of the car, they just drive past. They call it a drive-by sometimes.
Yeah, just to make sure that the property is there.
Yeah. What if the banks, from Stephen, what happens if the banks are nitpicky during the refinance process? Probably need a bit more, Steve, from overseas that you're working on at the moment with 5. Yeah. Do you know what he's referring to there, or without?
What if the bank is nitpicky? What did you say, the question?
What happens if the banks are nitpicking during the refinance process? So that's
the nitpicking is not, it's really just probably they want to know more about, for example, if you're an expat, so obviously there are more documents that they require.
Yeah.
And the refinance is the same as the normal refinance. It's nitpicking. It's something to do with the borrower.
The banks are terrible. Like at the moment, like their turnaround time has been disgusting.
Yeah.
Really, really disgusting. What's the turnaround time at the moment for banks?
Well, on average, at the moment, it's probably 20 days average.
20 days to get approval. And the amount of information they're asking is greater and greater. Constantly, they're just asking for more and more information. Question here from Luke. Hi, Rose. Do I need to go principal interest after 5 years of interest only, or can I just go to a new bank and restart the interest only again? How long can I do this for?
Hi, Luke. It depends on your, if you feel like you can afford the principal and interest repayments, then go ahead, do the P&I. But if you feel like you want to maximize your cash flow because you may need to purchase another investment property, we can always ask an extension of that 5-year interest period. But the problem with that, you may have problem with the servicing, because what they will do then, the current loan will only be amortized of the remaining 30 years. You've already done 10 years, so they will if you're asking for 10 years, they will amortize the loan within 20 years. So servicing could be an issue. So if that is the case, and if you really want to do interest only, we may have to refinance your loan. We make sure that when we do a refi, that you're not disadvantaged. Now, with the refinance at the moment, there are a lot of lenders there that do rebate, cashback, and the cashback can help you defray those expenses from moving from one lender to another lender, i.e. the government charges, the registration of the mortgage, registration of title. Now you can get sometimes 4,000, 3,000. So it might be worth doing the refinance. Also, it should be noted that it's easy. You can shop a better interest rate if you're a new client to the bank, a new borrowing. Now I've noticed that if we request for a better interest rate, if you're not a new to the bank, if you're an existing borrower, you don't give as much as when you're a newcomer. I do notice that. So sometimes we do the
get market share, I guess.
Yeah, I think probably because you're already there, right?
Yeah.
They don't need as much
the
new business. So sometimes it's worth refinancing. That is if you're not disadvantaged, we will do it.
Cool. I know actually you're doing one at the moment for a very long time investor of ours. I don't think he's on here today, but I know that you only refinance one because we had to take a certain bank to crack out equity in Queensland. So keep the questions coming. I've got one more question I'm going to answer right now. We'll go to some more slides. We'll come back and answer more shortly. How does interest-only loans affect serviceability? How does interest-only loans affect serviceability? Yeah.
Interest-only loan affects serviceability because the bank has a 30-year term, right? If you go interest only for 5 years, that means the loan can only be spread throughout 25 years. So the way the bank do assess the loan is they have this assessment rate or stress rate. Now, if the actual interest rate is 3%, if they add 2% of that or 2.5, that means assessment rate is 5.5. Now that 5.5, that will be the benchmark to use in looking in amortizing your loan. So amortizing it only for 25 years. So hence sometimes what we do, if for example servicing is an issue, instead of going to 5, we do 3 years. Then you're probably better off servicing that.
Yeah.
So interest only can affect your capacity to borrow.
Yeah. Cool. Moving on, keep the questions coming through. I'm going to go to my all slides here. So are you getting a discounted rate on your home loan, Rose?
So, let's talk about variable rate or fixed rate, whatever you want, right? Now, with the bank you have, they call it package. It used to be the old term was professional package, right? Now it's no longer, right? It's just a package loan. Now, if you are a package loan, they have the standard variable rate. Now, when you have a standard variable rate, depends on the volume of your loan, we ask for a discount, right? So we shop around for interest rate discount for you, right? Maybe this one is a better discount. So, for example, you do investment loan, P&I, we would ask probably 2% discount of your standard variable rate. So if it is 5.39 minus 2%, that means for the life of loan, if you stay with that, is only a 3.39 interest. So are you getting the discounted rate or are you getting good discount rate for that matter?
Yeah.
So with Zinger, we shop around. We'll make sure that we can, if this bank can only offer this much, I said, what about we try this one? It doesn't harm, it doesn't cost. So we do a lot of background work to offer you a better rate. So there are also, say for example, if your loan is small amount loan less than 250,000, we may have to go with a basic loan. Even with a basic loan, there are some special rate for a basic loan. So if you're using another broker, if you're using us, we make sure that we've already exhausted what's the rate good for you. So is your rate discounted rate?
So how much under the market are they getting? Is that what you're saying?
Yeah. Or some of them they're only getting because they haven't reviewed their loan. They're still getting a 1% discount only, or 1.5. There's no 1.5 anymore. It's like 1.8, 2%, or 1.9.
Yeah.
So if your interest rate at the moment is only 1% discount because it is an old loan, it's probably been established there for the last 3 years. It could be only like 1.2% of the standard variable rate.
Yeah.
Now you could probably shop with 1.5 or 1.8.
That's the first time I actually realised that. So even I'm learning something here. So I never look at the interest rate.
But we do shop around for better interest rate for you.
Yeah, and I'm going to start talking about some stuff later on in the later slides. But yeah, I've got a few things that will follow up from that a little bit later on. I'm going to make a couple of notes here. But over to you, Rose. I've got the notes here, but.
Are your properties cross-secured or are they standalone? Now, this is really, I'm very passionate about this because I often see it. Right? Now, I always ask, probably in every 5 loans, on every 5 application, one of them has been cross-secured. Now, we don't do cross-secure, with Zinger, we don't cross-securitize them.
We've never had it, not even one loan in the last 9 years of the business have we ever crossed a loan ever for anyone.
Yeah.
So, yeah.
I think the problem with the cross securitization, I'm just going to give you an example, right? One of the clients, right, he's got a property with NAB, for example, that was with NAB. They're cross secured. We know one of the properties has high value. It is valued higher with another lender, and we want to refinance that particular property because to harvest the equity for the new purchase. The problem we have is that it was cross-secured by another property. The second property that is cross-secured didn't do very well. So what ends up is that if we take this property out, that means the remaining loan balance may not be enough. The security may not be enough for the remaining balance.
Yeah.
So you end up paying. You can if you leave that particular security there, you might have to put in some money just to be able to do the satisfaction, like make sure the security is enough to service that loan. So that is the problem. And also with the cross securitization as well, when you do when you also wanting to sell the property, refinance, sell the property, and also you can't do, if you do portability, it's also difficult to do portability. Say, for example, your circumstances change that you're not able to service the loan, and that particular property is it's not performing very well, so you need to replace that. But if it is cross-secured, it's too much.
When you go cross-securitized, it's very difficult to pull out equity. You have no options. The bank have more control over you. You don't have the control. The bank actually takes control over you. I've seen people that have sold a property. I know someone that had a terminally ill partner. They sold off the property to help during that period of time. But when they sold the property, the bank took all the money. They thought they were going to get like 150, 200 grand, and the bank took all that money to pay down some other debt, and it really screwed them up. So I noticed. Also, someone in here, Andrew, wrote, I agree, cross-security is bad. However, the banks also give you an all monies clause, meaning if they have multiple properties with the same lender, they can still sell the other properties. All loans have the all monies clause, and the banks can call in for their money. So just be clear of that for everyone. That if the bank ever wanted to call anyone's loan, they have the right to, because it's just, the all monies clause. So
I've never heard. That's an old thing, isn't it? Well, it's a standalone loan, it's a separate loan agreement.
Yeah, so it has a part of the terms. It's an all monies clause. So I haven't seen one. I haven't looked at it recently.
I don't think it's a. I think it's a thing of the past.
But I think there was more around the times before the financial system was manipulated as it is today, and the liquidity. They just print more money, and the central banks give the commercial banks more.
Okay, some of the question that some of our clients would ask is that.
Guys, were you reading these questions?
No. I can't read that far.
Okay.
It's too tiny. What happened, like, when I asked why is it cross-secured, he said, because we don't have enough deposit and we're relying on that other property for the deposit. And what the bank does then is said, okay, we'll do it together. So that's how the cross-secured happens. However, if you're a good, normally it happens most in the branch. You can structure it like, okay, if I need the equity on this property to use as a deposit for the second property, you can do a split loan for the particular security, right?
Yeah.
So first one, and the second one, maybe a portion of that, whatever is excess equity, to use for the second property. So it's still not cross-secured.
So I had someone yesterday ask me, which I can't give financial advice on, but just, mates and having a chat. So someone asked me yesterday, my parents want to gift me $30,000, right? And they give me some money. And they go, the guy actually asked me, like, should I get my parents to to go guarantor on the property, right? And my feedback was that once your parents go guarantor, you are on the prop there, you're in business together with that loan and with the property. And the bank then take a charge over your parents' property. So the risk is if something was to go wrong, we're only talking like properties for 150 grand or so, so risk is minimised. However, if something did go pear-shaped, then the parents' loan the property would be cross-securitized with that deal. So the loans are cross-securitized on that front. My thoughts on it is that if the parents were to do something in gift, then the worst case is if they pulled out 30 grand worth of equity against their loan, then that's the worst case. They just lose the 30 grand instead of having their property completely tied.
Yeah. So it's a limited exposure from the
Yeah, I'll notice here a question here from Angela. Is it advisable to get multiple loans from the same bank or spread it over different banks? I know a lot of people would have thought with the old mindset.
Yeah, no, it's not. We normally saturate the multiple. We do a lot, like one lender could have 10 of the loans. It's as long as it can service, we use that bank.
If the bank's going to support my goals, I'll use them until they can't help me no more, and I'll move on to the next bank. So I'll exhaust one bank's capacity out, and then move to the next bank, drain them out, go to the next bank, drain them out. So I'll stay with the bank until they can't lend to me no more. Elizabeth, hi Nathan Rose, can investors in New Zealand buy existing property in Australia, or does it have to be new properties only? It's probably more of a legal question.
Yeah. Actually, if you're a New Zealander, work in New Zealand, you are classified as the same as the Australian. You can purchase a property here. No requirement of the foreign FIRB.
Yeah.
There's no. It's just like an expat.
Yeah. So if you're in New Zealand, you're watching this, reach out. Rose will be able to help you out. I know that I can see names in here, and I can see people that are based in different countries around the world and different locations, and some are not even native to Australia as well. They're from New Zealand and from other places. So doing a 90% LVR with LMI, do the banks really care how many 90% properties you have as long as they are protected by the LMI? Also, what appetite do the insurance companies have for multiple 90% LVRs?
Well, we never have a problem having a 90% LVR, and normally they might be a cap on how much maximum lending you're allowed to. Normally second year they have a cap.
Yeah.
But there is no problem with the big four banks.
But once you hit a certain point, once again, if you are going 20% deposit and 80% loan from the bank, you are doing business with the bank. The minute you go over that 90% and you have to go to the mortgage insurance territory, the mortgage insurance company puts all the terms and conditions onto you. So there is the mortgage insurance company isn't going to say you're going to have 20 properties or $10 million.
Or $20 million worth of loan under
the security
LMI,
the mortgage insurance, like you can't go get properties that are 5 acres, you can't go get properties that are over $1.5 million. There's terms, I got to know those exact terms.
Yeah, and also saturation as well. Sometimes the mortgage insurance will not cover it. They would say we will not do LMI for the certain areas.
Yeah.
Saturation or
If the bank says I cannot borrow anymore, will other banks lend? Do they use different lending criteria?
We always do that. Like we have always an option. There's always an option.
Yeah. That's the thing, right? Like most people just get told from their bank, no. When I met Rose, I was with St. George and they told me you can't borrow anymore. And I was like, through with that. And that's when I met Rose and started getting loans with other banks because they had an appetite to lend to me and their lending criteria was different. So,
and also you have to remember each lender has different assessment rate. And some lender has 5.1, 5.25, 5.3, or some lender would take investment expenses as part of your expenses. Some lender would not. Some lender would take 80% of your rental income. Some lenders would do 75%. So.
Matthew, hi Nathan, do you still see rates going to zero and negative, hence better not to get fixed? I can't tell you to go fix or not to fix. However, I am seeing a few things out there. I'm going to talk about that a little bit later on this evening, my views on what's going to be happening with the interest rates in the market. I think that's on a slide. Yeah, it's on a slide, and I'll cover it tonight. Interest rates, if it's not on the slide, I will talk about it. And one last question before we go on to the next slide. How do you increase your servicing by purchasing a property, which means taking on more debt? One of the little notes that I put here beforehand is of an investor which we've been able to turn around their position. Yes, it is taking on the debt, but it's actually acquiring the right assets in the right sequence. So we can, if we can't service today, we can always get ourselves back into servicing. So whenever any of our investors that I work with closely via property investment agents, whenever Zinger tell me that they can't service or that they're getting stuck or whatever the case may be, there's a question that I always ask, and that is, how much are they failing servicing by? And you should always be asking, you know, how much am I failing by? So if your broker says, you know, you can't do a deal, well then, why can't you do it? I want to know every question about it. Why can't I service? How badly am I failing servicing by? They might say you're failing servicing by $200 a month. That's $50 a week.
It could be a matter of credit card being cancelled.
Could be a credit card being cancelled. It could be, you know, purchasing a property that's cash. So we had an investor who was failing by a few grand a month, and I was like, okay, how are we going to get him back into servicing? So he sold off one of his properties. And I'm going to talk about him a little bit later on, and he might even be on here. He sold off one of his properties, which was a block of land, and that reduced his debt exposure. Then he had a cash component of 200 grand, and we went and bought 3 properties that were about $50,000 each for these properties. The properties then brought in a cash flow of 200, 250 per week rental income. So his servicing went up by about $600-700 per week. $600-700 a week because he owned them cash. The bank will take on how much of that rent?
75-80.
Say 75-80%. So they may take on, let's call it $500 a week. $500 a week times 4 weeks, that's 2 grand. So his servicing's now increased. And what we're able to do is really amazing. I'm going to talk about it now rather than the last slide, is that his position with buying these properties increased his cash flow by that much. When he was in my office the other day, we talked about the rents. The rents were low, so we boosted the rents up by $140 per week, where my instructions of going back, increase the rent. So it's going to continuously boost his cash flow. And then we're able to pull out one of his properties, which is a 450 grand loan. And from that 450 getting refinanced was at 5.5%. We're able to reduce that down to 3.5%, which will save 2% on 450 grand, which is 9 grand per year. And then we're able to go and take another property and refinance that at 450 with the same pricing basically, and save 9 grand a year. So his position was to save about 25 grand a year. He'll be better off 25 grand a year. So sometimes it's a matter of the assets that you add into your portfolio. You can add some to increase your position. You could get rid of some debt by getting rid of a credit card or getting rid of personal loans, selling off your car. Actually, someone recently from over in Western Australia that might be in here was going to sell off their car. They couldn't service with CBA anymore, one of our investors, and they paid off their car loan, and then they were able to go back and pull out equity using CBA. So it was just restructuring that debt and how the banks calculate it. Any other comments, Melanie?
No.
Next one. Why is it important to get your home loan structured? This is we sort of just covered that.
Yeah. No, okay. It is important to have the right structure for your loan. As I said, look, first thing is not being cross-secured. It is very important. Secondly is, are you getting the right interest rate for your home loan or for your investment loan? And are you currently have a lot of equities in your loan that you may want to harvest, or are these are you if you purchase another investment property, is this lender are you still sticking with this lender when you cannot be servicing anymore? So structuring a loan is very important, because if you wanna continue to become an investor, your journey to become to purchase more properties, it is important that that structure of your loan is, are you able, i.e., is it flexible enough for us to refinance that loan? And if we cannot refinance, is it flexible enough? Like if we have to stay with this lender, is the valuation good enough? So good structure.
And what's the longer term goal? Like, are you going to be thinking about selling off your principal place of residence and moving in 5 years? And, yeah.
Well, I've noticed lately some of these investors, they're renting.
Yeah.
But they have like so many properties, but they're renting.
Yeah. So always be good to your tenants. You never know who's in your place.
Yes.
Yeah, cool. And I think, all too less of the time, like people will just go out looking for the cheapest interest rate. I noticed here there was a question from Luke that said about always love having Rose on the show. In the asset acquisition statement foundation portfolio, should we be more focused on serviceability and borrowing capacity rather than trying to get the lowest interest rate? Without giving you guys financial advice, I believe so personally, due to the fact that the structuring of that debt, if the market was to double tomorrow, which it's in a boom at the moment, would you rather take $1 million and double it, or would you rather take $5 million and double it into $10 million? Having the largest asset base, so the terms of the loan are better than the interest rate. If any of you guys and girls on here today had $1 million and you said, I can get a loan at 5% even, I would pay you 10% for that money and go and do something with that money to get a greater return than 10%. So the terms of what is important. I wouldn't care what interest rate I'm paying, as long as I'm not asking anyone to give me their money, that's fine. I've got lots of things going on myself.
Can I add to that?
Yeah.
When we do, sorry, did I cut you off?
No, that's fine.
When we do when we assess your capacity, we look at first your capacity to borrow, right? There's no point of going to a low interest rate if you cannot borrow on that property, on that lender. So we look at the servicing. We look at also if there is a refinance, if the valuation matters. So capacity to service and valuation. And then we look at the interest rate. Interest rate also matters, because if the interest rate is higher, that means the assessment rate for capacity to borrow also, it will impact, right? Yeah. Because if you are getting 4% and if you have to have a stress rate of 2.5 to add to that, that means your capacity to borrow will be assessed at 6.5 instead of 5.5. So those three are important, but capacity to borrow, valuation, and also interest rate. And we'd like you to have a good interest rate as well.
The interest rate's important, very important. However, obtaining the debt is crucially important, and understanding what the longer term goals are, understanding what the bigger picture is really, really important, and takes a crucial role in doing so. Looking at one last question before we move on, we've got here, Neelam, I'm in the process of structuring my loan. How can you help me? I think we need more information than that, so we'll wait till a little bit later on and talk about how to get in contact with Rose. Any other things to comment on that? Keep the questions coming through, and most importantly,
this is everyone is asking for.
What's happening? Right, it's March.
Changes coming in March.
It's the 3rd of the 3rd, 2021. In March, they said last year, for those of you that aren't aware what we're talking about here, Frydenberg, the treasurer, said that he would be reviewing and APRA would be relaxing lending criteria. So why do properties go up? There's lots of videos that I've put out on that. It's not about the property itself, it's about the manipulation of the money and the access to that. So I know just from those of you that are watching this webinar this evening, that there's so many of you that would love to buy property but can't buy it. And then if you think about the greater marketplace, if someone's told they can borrow $1 million, they want to buy a property for 1.2. If someone's told they can borrow 700 grand, they want to buy a property for 800 grand. Rarely do people sit there and think about it wisely and go, okay, great, I can borrow 800, I'll get a loan for 200. So we're in a position where people want to get debt, they don't have access to it because APRA came in and tightened things going back in 2016. Frydenberg said as a part of the coronavirus stimulus packages that they would be relaxing and removing all of those laws. And there's a bill that's being passed, it's in Parliament at the moment, to remove and scrap a lot of responsible lending. So we've just had a Royal Commission, and I laughed at the time. I know a few of you guys in here were a part of my mentoring program where I talked about this right at the time and talked about that would be right here in the future where it will become easy to borrow money. So we've got money at almost zero, right? We've got interest rates of 10 basis point, 0.1, 10% or 1% is the RBA's interest rate. We've got, someone just asked me beforehand, do I see this going negative still? I believe that we will be going negative very shortly, and if we don't go negative, we may see a short uptick because our currency is crashing, which we're starting to see around the world. So don't get too scared by that, but ultimately they're going to have to print their way through this. So that involves basically a lot of stimulus packages, a lot of money being printed, and so just seeing the questions coming through. It's all right. So looking at the...
You get sidetracked from the question.
Yeah, I do. I see them all come through. Ding, 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 ding.
I'd like to answer this.
But with the access to liquidity, right? So we've seen interest rates come down. People are paying 2.5%, 3% interest rates. They are now going to be able to get access to the money much easier with the changes that are coming through. Rose, I'll leave it to you with...
Okay. With the response, obviously this hasn't been ratified yet by the Senate, right? So what they were proposing is the burden of responsibility lies now with the borrower. Now, I'd like to expand this one coming in March, because when we do, for example, the changes could be the information that you provided to us. At the moment, the information that you provide to us, we do investigative work, right? It takes a long time. We look at your transaction account for the last 3 months. We look at your credit card for expenses or undeclared liabilities. So a lot of work before we can even start doing the loan. And the bank do the same as well. So it causes a lot of time and work. Now, for these changes in coming March, the responsibility lies on the borrower. The information that you provide to us will take that information. So now, having that information, you also have, for example, expenses, right? You make sure when you declare the information, the expenses to us, be truthful about it and make sure it doesn't end up like you'll be in financial difficulties once you have the loan, because we are reliant on those information. We know if these changes come through, we no longer rely on checking it, but rely on the information that you provided. So what the good thing about it, right, since if that happens, then the processing time for the bank will be quicker. Yeah, It might, the approval time may be quicker, and also for us to write the loan may be quicker because we don't have to go through all these things. Now, and also with this responsible lending as well, the lender and the broker are free from that responsibility. And also it may be a good thing for you as well, because sometimes the lender set the expenses. I'm not sure what the lender would say with this when this is ratified, because they have a certain hem, right? Now, hem
so what's it mean? What's hem mean for people?
Housing expenditure measure.
Yeah.
I always get the thing. Yeah. So with hem, for example, if you earn, say, 300,000 between the two of you, no children, the bank set aside a 60,000 living expenses, give and take 59 to 60,000. No, that's the bank hem. Now, if I know some of you would not spend 60,000, that's a 1,000 a week almost, right? Now, if you don't, if you have to give that information based on your information may not be that may not be up to 60,000. I'm not sure if the bank would lower their hand.
Some people live at home, like I lived at home,
Yeah.
till I was
Yeah, but
25 and stuff like that.
the bank may lower their hand based on your information, or they may not.
Yeah.
So there's still, I'm sure there's probably a benchmark, but at least now it's less work for the lender and the broker. We're reliant on the information that you provide, and just make sure that they are honestly done, because we don't want you to be in a struggle once you have the loan because you provided a lower expenses.
Yeah. And what are any other thoughts on it, or?
Well, I will welcome it, and then some lenders would really welcome it, because
It'll be amazing.
it will be amazing.
We're going to see one of the biggest property booms from this. We've got 0% interest. Like, if interest rates were nothing, how much could you service for? You could service for as much as you want, right? So there's going to be a lot of people.
It's already started now, a lot of 2 banks already lower their assessment rate. Like ANZ come up at 5.10 assessment rate. It used to be 5.40. So, that's a welcome news.
Move, yeah. So the only way that they can push house prices up, it's not the house that goes up or the unit that goes up. It's not the property that's going up in value. It's the access to the money that's cheaper, which is destroying the availability of, the prices that you need. So this is going to cause a lot of price inflation, should we call it, to the property market. We've already seen with the drop of interest rates going down from where they were to where they are now. Like, we've seen a lot of markets double in the last 12 months. We've seen a lot of markets go up 30, 40, 50%, especially the ones that we've been playing in. So I could only imagine what it would mean if we threw a whole lot of jet fuel on there, which this is naturally, like some of the properties that are out there, with a 2% interest rate or a 3% interest rate on 150,000 purchase price of a property, that means that those people would need to spend about $100 a week on their mortgage, which is so cheap, and that will inevitably push those prices up with the cheap, easy access to credit, which is funny because it's totally against what the Royal Commission was allegedly about. But,
I think this is to rescue the economy.
Yes, stimulus package. The currency is so far screwed, the economy is so far screwed, they've just got to print money and give it away how they can.
Let me add this one. So I've asked a lot of BDMs for different lenders, right? I said, we have a record month for February. And they say they have the same as well. I mean, I wonder if there's a lot of movement at the moment, right? People, they can't go away, they can't go overseas. So what they do is when they're at home, they decided maybe I'll buy a property, revalue my property. So it's a purchase market at the moment.
Everything's getting inflated though. But the economy is built, like this is going pretty deep. But I'm going to go on those tangents, Rose. The whole currency that we've got is a Ponzi scheme. People go, I was property in a bubble. I noticed that William wrote, with the burden of responsible shifting to consumer, do you see that we will see something similar to a US housing crisis? Our financial system, people say, oh, the property market in a bubble or whatever. Everything is in a bubble, right? If we go back 10 years ago, people drive around a 20, 30, 40-year-old car. But now, when you go to buy a car, they're not selling you a car, they're selling you finance. The car's the asset that they're attaching to it, right? They're just selling out finance. When it comes to housing, the house has become, housing everyone lives in, has become an ATM machine. So people are going out, getting themselves in their debt, pulling out equity, buying themselves cars and doodads and, furniture and whatever. And that's what keeps the economy going. What we've seen is a contraction of the credit supply, so people don't have easy access, so it has put a damper into other areas of the market. So the government can keep printing stimulus checks, stimmy checks, giving it to people, or they can manipulate a few other things. And ultimately, when it comes to the property, and they start manipulating these things, we're going to see money flowing into the property market because everyone has easier, cheaper access to getting that credit, ultimately pushing up, the property market.
Do you notice the old, years ago, when valuation is high and then people accessing their equity, and that equity doesn't necessarily translate to purchasing property, it translates to going away, going
Yeah.
overseas, and that sort
But
of
now people want to get access to the assets because they're waking up that money is worthless. Your money is buying you less. So the more assets you have, the more inflation you're getting. So really, like in this time, he who has the most assets wins because everything's getting inflated away, and debt is becoming cheaper to pay off. I remember back in the day, 100 grand in debt, I felt like I was going to go bankrupt. Like 100 grand debt, like
it's just a personal loan.
Just just nothing, right? Like people buy a car for 100 grand. I just bought a Ford Ranger beforehand. This little fella out there, and that was like last year. I paid 74 grand for a brand new, and they're worth like 85. Now they're selling for 85. The price of the cars are going up. Debt's nothing. So basically, the economy is built up. If we think that debt's a problem out there, the government's got so much debt. Matt just wrote here, ScoMo was borrowing money to stop the economy crashing. The country got into $1 trillion worth of debt. Last year, we printed $1 trillion worth of money to give it out to stimulate the economy. We've seen the house price go up a little bit. We've seen this go up. They're basically just printing out money to stop off the whole system.
And printing more money to buy back the government bonds.
Buy back the government bonds. So, so getting onto the interest rate, well, interest rates continuously come down, and are we going negative? The interest rate right now should be -2 to -3%, and this is probably not the best webinar for us to talk about that because I've covered it extensively and had actually the charts many times over about how the zero bound has been broken, but for some reason all around the world every interest rate is sitting at 0%. We're not at a point to go negative yet, but recently stimulus packages haven't been working. The 10-year Treasury bonds in the US have been spiking up massively, and even in Australia, the 3-year bonds have gone crazy, and now we're seeing pressure for them to print more money. If they don't print enough money, the interest rates will rise, and I think in the short term, we may see some pressures there to push up interest rates, not that they will go up. None of this is financial advice. I believe that we will see pressure of the interest rates, so you may see them go up one smidgen, one little bit, but then they'll have to come crashing down, and they're going to have to keep printing their way through this. So it's inevitable. Either they're going to print a lot more stimulus checks, they're going to do a lot of communist spending, they're going to reduce and remove all these changes here to try and soften the market and soften the blow to the recession, but basically they're just printing over the recession / depression. It's not a recession, it is a depression. People don't feel like we're in a depression. We're in an inflationary depression. So we're in a depression, but it's that you can't afford anything, which is very different to normal because it's fully artificial. It's a big debt bubble around the world, and we're at a point where they just have to keep printing this money to keep it alive.
So what happened after the JobKeeper stops?
Well, they've already started printing off money. They're going to take from the government printing off the money so everyone else can print out their own money, which is it's a Ponzi scheme. When people say, oh, the property market's in a bubble, property in the market's never been in a bubble for the last 10, 15, 20 years minimum. Mainly since 1971, it has not been in a bubble. It's the money that we're using that is in a bubble, and we're in a debt-based Ponzi scheme out there, 100% artificially manipulated from the central banks around the world. And it's exciting. It's a great time to be alive. I actually remember having a chat with Ridwan once. Ridwan's our accountant, for those of you that don't know who he is. And I was talking to him, I made a comment and we laughed about it, and it's so true now. The debt is becoming an asset. The actual fact that you can have debt and pay off today's debt with tomorrow's inflated and devalued currency is amazing, because you can take out debt today and then everything gets inflated and you can pay it off with tomorrow's money, which is devalued. So it's crazy. It's great. Got a like here. That's great. Is there a glass ceiling you hit of debt you can obtain until you have produced more income to continually build a portfolio? If so, how can purchasing a property that comes with debt help increase servicing? So I'm going to use the example from beforehand. It's the same similar sort of question, but literally, if someone is not able to service, you need to ask how are you falling short by servicing, and you can either go out there and earn more money to build up the servicing, or the assets that you can acquire could be more cash flow based. If you're buying them cash outright, then the cash flow will be taken, as Rose said beforehand, from the banks at 75, 80%. and that cash flow will help boost yourself back into servicing territory. So you continuously need to be working on your asset accumulation strategy, your cash flow management of your properties by pushing up the rents wherever you can. That's why rental increases are very, very important, as well as looking at the debt strategy as to, okay, how are we going to navigate through? Out of my portfolio, currently I'm at about 230 properties in my position, which is going up, which is great. However, I'd attribute probably half of those properties that I own, I hate them. I never even wanted the properties to start off with, right? But I bought the properties in order for me to be able to keep the banks happy with what I'm buying. I remember when I bought, going back, I was maybe at like 7 or 8 properties, I asked Rose for a loan for a property. And I asked you for a loan for like a $200,000 purchase price. Rose said, no, the bank wouldn't take that. And I was like, okay. And then somehow I found a townhouse, and I'm not a fan. Yeah, that's someone.
You own two.
I own 2 there. So I said, hey, Rose, with the properties, can I buy this cheapie? And she says, yeah, it works. So I could buy a property that's $130,000. I bought the property for $130,000. Another one came up, bank repo. I said, hey, Rose, can I buy the property? And she goes, yeah, you can buy that property. And then I was like, hang on a second, I just bought 2 properties for $130,000 and $140,000. That's $270,000, but you told me beforehand I couldn't get a loan for $200,000. And she goes, Nathan, you've got 2 rental incomes coming through, and then those 2 rental incomes supported for that extra cash flow, for the extra debt that I was taking on board. So you can naturally cure your position via, just tweaking things in your portfolio. A lot of people come to me on a day-to-day basis. That's why I say the Dr. Dre of property, the original gangster out there, because people come back to get their portfolio sort of fixed when it's wrong. Is it cash flow we need to push up for the lending? Is it the asset, that's the right assets in your portfolio?
Or is it capital growth?
Yeah, do you need equity? The next property that you need to be asking yourself, do you need equity to get your next deposit? Do you need cash flow to help service? And each step along the way, this is why here at B.Invested, we're able to build large property portfolios, 10, 15, 20 properties throughout APRA, where people say it's impossible to do so. We've been able to build more of these portfolios than probably everyone else out there combined. And we actually meet some ATO statistics because we've been able to build those large portfolios. So yeah, looking at it, it's not about the property, it's about what do you need the bank, what do you need to do to keep the bank happy? So each property needs to be in line thinking, do I need equity? Do I need cash flow? What is the next hurdle the bank's going to throw at me? And thinking about that prior. When I'm building portfolios for people, I'm not thinking about the property today, first property or second property. I'm thinking about property number 4, 5, 6, and 7, because I need to work out, do you need equity? Do you need the deposit? Where's your deposit going to come from? Where's the cash flow going to come from? And how is this going to help you, get to the eventual end goal? So it's important to bear in mind and to think about how's the property going to work and how's the debt strategy. The debt is at least 50% of the property. It's not about the property. It's about getting the right property to fit in line with the debt strategy to keep the bank happy, to keep lending to you. So the difference between someone going out there and buying one property, let's call it a house somewhere for $400,000, or let's call it 3 other houses for $250,000 or $300,000 each, but the cash flow is servicing for the bank and the equity is coming in for the next deposit. You need to build that portfolio strategically, which is, Any other questions?
No, I just see some of the investors properties, right? They have like 700,000 or 800,000 property, and it's only rented for 500, which is only like 4% return. It doesn't. It's not correct. I think you'll have a dollar for dollar, like 5% return.
But we go for like 10% here. So
yeah, that's what I'm saying. Like some at 800 and only what, $500.
Yeah, people buy properties for 800 grand. They rent for $500 a week. They buy something for 500 grand. It rents for $500 a week.
Yeah, that's 5% return. At least you have a 5% return.
But if you can buy something that's giving you extra cash flow, then that cash flow is going to make the bank go, shit, this guy's on so much money, we'll keep lending money. So you need to look at what the bank is going to require from you before you make that move, because people will go and buy a property and then they'll shoot themselves in the foot and screw themselves up, and they can't do anything else. They can't refinance, they can't get their equity out. You know, sometimes before digging that hole, you need to first stop digging and going, what do I really need to do? A lot of people will just go and buy the property, but without analysing, okay, what is the bank going to require? Just like any business, you need to work out a business plan for your property acquisition, as well as how you can, you know, grow and move and expand and do all those sorts of things. And generally, it comes down to either the capital to buy the property or the cash flow to service the property. So if you can get the capital to buy the property and you can keep the banks happy with the servicing coming through, then it's going to be fine. If you have $500,000 in capital, that's great. But if you screw yourself up, you're only going to get 3 or 4 properties if you're lucky, and then you won't be able to buy any more. So how do we keep, you know, working in perpetuity? So, yeah. Next slide. Will interest rates rise? That's the one that we won't go into this one too much because I just talked about it beforehand. I believe that we've got interest rates at 2%. It's very, very cheap out there in the market at the moment. I believe we're going to go negative interest rates. There is some Danish banks which are going negative at the moment, and there's, you know, a lot of indications which are going to show that we're going to go down even lower than where we already are. There are some short-term things happening out in the marketplace, which happened going back 2 years ago, where we saw 2 out-of-cycle rate hikes, which, you know, basically went up a little bit. Then we saw the interest rates fall down. So if we look at what happened in the US, we saw interest rates had gone down to 0. They went back up maybe 2 times or something like that. And then what happened is the interest rates came back down because they can't, just reading comments that come through.
Yeah, I'm reading it. Yeah, sorry.
Yeah, so I will get onto that one in a tick. But I believe that we're going to see the interest rates stay where they are. We're going to see other stimulus measures come through via, you know, access to cheap credit, access coming through, which is like the last slide that we're talking about. But we should already be at -2 to -3% based on the bonds, based on, you know, where everything has been. There's charts which show that lines have been crossed and they're death crosses, which means that once they cross over, you know, something really bad generally happens. And we're there when it comes to the interest rates, but they've been artificially kept up at a zero-bound level at 10 basis points rather than letting them go through to negative. When they do go through negative, it's going to be a spectacular show, and that's where I'm going to be very, very excited because, you know, the banks are basically paying you to take money. At the moment, if you have interest rates at 2% or 3%, if you were to earn $1 million, you'd have to pay 30% in tax plus some GST, or 40% or 50% in tax. You'd be paying tax for the next 10 years, 15, 20 years worth of interest based on the interest rate at the current moment. So, for example, $1 million at 3% interest is 30 grand a year. $1 million of paying your tax on it, probably losing 400,000 for it from it. So, inflation is going to have such further growth than, you know, where we're at the moment. So I personally do see interest rates going down lower. This is not financial advice, so I'm not telling you to or not to fix your interest rates. They are very cheap at the moment. There's some very cheap variable out there. There's some very cheap fixed rates out there. You know, I don't have any interest rates fixed at the moment. I've left them variable for a specific reason, and it's because I do see them coming down potentially even further. So any feedback from your side, Rose? No? Don't want to speculate on that?
No, I'll get in trouble.
Yeah. Rose doesn't give financial advice, and neither do I. Luke did write there, interesting comment by Nathan, that 50% of the portfolio is financed, not just a property, which is just a vehicle. That's the importance to own the chessboard, you're right. So it's, yeah, for me, give me a house, a unit, a townhouse, a shopping centre, an acreage, a block of units, a motel, whatever the case may be. I'm looking at how can I get the maximum amount of my finance because I want the banks to keep giving me the money. How do you get more debt? We did touch on it beforehand. As I said, you know, there's a few strategies that you can do to remove debt. One could be, you know, paying off a credit card. One could be, what are some of the things that people can do to reduce that to?
I think first thing is a credit card, reduce credit card. And secondly, I think when you have your expenses is more than what the bank's benchmark, we've asked the client to maybe review their expenses. It could be like they're overspending, like they don't live within their means. So we try to advise them that. And also, I get a lot of clients, self-employed clients, they do have their draft financials and they want me to cite, will I be able to borrow money based on these financials? So I do advise, I speak to the, based on what the bank's criteria, but most of the time I speak to the accountants.
Yeah.
Just to let them know, like before lodging, make sure like instead of dividend, maybe put that as salaries and wages, because then it's gonna assess at 100%, not at 80%.
Yeah.
So that sort of thing.
Yeah, cool. And yeah, looking at, so lots of questions coming through. So looking at how to get more debt, like that's some aspects that you can work on the finance side of things. However, looking at what you can do personally, right? Whether it be sell off the car, pay out the car, purchase an asset to help boost your cash flow. I've done some recently which are positive, like $500 a week. You've seen some of the little blocks of units, which are like 500 grand. They might rent for $1,500 a week. The extra cash flow can boost the servicing up. It could be that someone is to buy a property. Actually, I just thought of a strategy there for someone as well, which I'm going to make a little note here in my paper to talk about afterwards. But yeah, basically, with getting the right asset to boost up your servicing is very important. So you can buy properties in the country at the moment for 50 grand that rent for $250, $300 a week. Yeah, I actually have one of the portfolios I spoke about in my last presentation, which in the last 12 months has got 6 properties. We just got this person to their 7th property today, and my view is to get them to 9th property. And they started with 70 grand last year. However, one of the properties was a very weird one. It was $59,000 that I bought, and it rented for $250 a week. But we're able to push that rent up to $380, $370 or $380 per week, and that extra income is serviced for them to continue with their journey, and to keep them with the good banks that have good rates and good terms and all that sort of stuff. So sometimes it's working on what you've already got, and it might be bringing something else into the equation, which will assist in getting the financing sorted. So could you sell off something? Is that the best thing? I never hear people that go, I'm so excited I sold off a property 10 years ago. So bear that in mind. But in order to get more debt, what can you do to tweak your position? If you can push your rent up, that's going to bring more cash flow in. Are your properties up to speed with rent? Looking at the properties that I purchase for investors, probably 95% of the times I'm pushing the rents up, especially in this market. I'm pushing the rent up sort of 30, 40, $50 per week upon settlement, because they're just rented too damn low. If you're one of those investors that has a property that's too damn low, then is that something you can review to try and increase your cash flow for services? You've got 10 properties and you boost them all by $30 a week. There's $300 a week. There's almost $1,000 a month that they can add. Yeah. Any other thoughts on that? No. Swanee, I'm going to leave this one for you, Rose. How to save 30 grand a year. We have an investor that's probably watching this, and if not, they're going to be watching it on the replay, who last year restructured their debt and saved themselves $50,000 a year. I talked about it beforehand. I had one of my investors come in recently who we restructured their debt, saved them 2% on 450 grand by 2, so it's 9 grand a year on a 450 grand loan. 2% of that is 9 grand. Save that per year, times it by 2 properties, which is 18 grand a year. So
it is really important to review your current portfolio, because in this instance, right, his loans was with the
screen got all blurry.
So their loan was were with that particular lender, and they were in an old rate, right?
Mhm.
So previously rates are very expensive in the second tier.
Mhm.
So what we did, their financial has changed as well. Like she works more. So when we refinanced it, this was like a lot and a lot of savings. You're talking about 5.5% interest down to 3% of some sort.
Yeah.
Yeah. Now, as I said to you, like sometimes when you're with a lender and that loan has been there for over 3 years, it could be a high interest you're paying because you didn't negotiate for that interest rate. Now, better to review it, because as I said, sometimes you stick with that lender, they can only reduce it to certain, so much. But
Yeah.
if you get out of that lender, you could probably negotiate with different lenders and give you a better interest rate because you're new money.
Yeah.
So very important to review your portfolio, especially if you have loans that are over 3 years with that lender.
Actually, that takes me on to my next slide, Rose. So,
Oh, did I tell?
how often should I review my loans?
Well, if your financial circumstances change, like you have a better job, maybe then you can afford to have a better lender. That some of these lenders, the main lenders, they provide better interest rate. And if you are from a second tier, we could probably bring you to the four banks, or if not. I used to say like 3 years, but now because there's a lot of good interest rate, I think if your loan is over 2 years, I'd like to review that.
I actually think like if it's 2 years, it's too long. But like even if it's in like the 12 months, we should review it and go, is there something we can tweak? Is it something? Because even if it's keeping your existing loans, you could go to the retention team as well and try and say, hey, look, I've been offered a better rate. Someone's going to give me a better, cheaper product. I'm thinking of refinancing it. I don't want to go through it. We've been with you forever. They're offering me $4,000 if I refinance. What can you do? And sometimes it's just some advice to go back to the retention team and keep the existing loan and see if you can shave off 1% or 0.5%. Like if you got $1 million and you save 1% per year, there's 10 grand. So literally, like if you're on $3 million worth of debt, which is great, and you can save 2%, 2% of 3 mil is $60,000 per year. 60 grand, that's like an average wage in Australia. That could be someone that retires half a week, work 3 days instead of 5 days now. We've got a lot of investors which have gone down and cut their work hours down and their salary because they don't need it, because they've been able to use the property portfolio to boost up their position. So if you've got a $500,000 loan, $1 million loan, $2 million, $3 million, $4 million loan, we need to be reassessing that on a regular basis to be able to see what we can do to improve your position. Because as I said beforehand, we've got people that have looked at their position, they've had to do certain tasks over time. So sell off something, or they might have to get rid of their credit card or whatever, and then be able to put themselves in a better position. I've seen people that have sold off their car, they're driving a shitbox, and then they fix up their life better with their finances. They save themselves sort of 40, 50 grand a year, and then they've got extra cash flow. They can go buy a much better car. So, whatever it takes, but it doesn't always mean that you have to do anything like that. It could just be simply picking up the phone to the bank and say, hey, give me a cheaper rate or whatnot.
You can negotiate. If, for example, if you can't get out with that bank because obviously there are reasons like you cannot service anymore, right? One has lost his job. So just try to negotiate it yourself, or ask the broker that set that up. They can negotiate the interest rate for you. It's worth doing it. Really worth doing it.
Got a few questions here. When do you think the banks will adopt crypto? Sorry, the water went down the wrong way. Regarding buying with it, I don't believe the banks are ever going to accept cryptocurrency. Cryptocurrency is against sort of the banks and what they do. PayPal has opted with a trade with it, so you can actually trade with PayPal. However, is that then using it as a currency? No. And if the banks were to adopt it, it would mean that they would kill their currency, kill the dollar, and basically bring down Western civilizations with it. So it is anti-system, but I believe the banks will have some sort of mark of the beast cryptocurrency digital dollar, which will be a very centralized version. People think it's a Bitcoin or an Ethereum or whatever sort of cryptocurrency they can play it to be. But if it's come from the government, it's going to be some dodgy mark of the beast, control, track, trace, chip you sort of system, which will not be a cryptocurrency. So basically all the currency at the moment is digital currency. Did you know that only this was before Corona, 3% of currency was actual physical, the rest of it was digital. They've printed last year more currency than there ever has been in 1 year than what there ever was in existence beforehand. So it's probably closer to 1% of money is actual physical, the rest of it is digital already. You just believe that you've got control of it, but it is based by a central controlling entity, which is fraud and manipulation, which is the central banks around the world. And I feel very comfortable saying that I don't give a shit what they feel with my opinion on it. But
very passionate opinion.
So yeah, I've got asked here, can we find the replay of these videos? Hit up the team, email us at admin@binvested.com.au if you wanted to see previous ones, and you can get access to them. They're all stuck as a replay version. I just don't know how to direct you there from a tech side of things. Question here for you, Rose. Does using a mortgage broker provide any extra benefit? Example, better rates compared to going directly to the bank?
Oh, for sure, 100% for sure, because the broker is always going to shop around for the best interest rate or for the best whatever, either interest rate or better lending. If you go to the bank directly, all they can offer you is their product, right? Whereas with mortgage brokers, we're accredited with a lot of lenders. So sometimes they said, oh, I went to this particular bank. I said, why did you go there? If you're going to refinance, you don't have a problem with your servicing, there's another lender can give you a refi of 4,000 and 4,000 refinance and 2,000 for each, thereafter.
The bank's only going to sell their product, and they only have limited boundaries what they can work with. Whereas having a broker, like a lot of brokers are shit out there. I've seen lots of terrible brokers over the years. Having someone that has experience to structure the debt and put a strategy, have a debt strategy is very important. I don't see brokers giving debt strategies out there in the marketplace. It's just not something that happens. So, yeah.
And then if you go to the branch, they cross-secure your property.
The banks always
cross-secure your property.
And it screws you up. You can't build large portfolios. There's a reason why not many people have 6 or more properties in the country. There's less than 18,000 people with 6 or more properties in their portfolio. And the reason being is that the finance gets screwed up, whether it be the acquisition of the asset to the debt, or whether it be the structuring of the debt, which screws them up. So the importance is there with getting that right.
And also we are contactable I am contactable, even on the weekend. So, and with the bank you can't do that. It's only 9 to 5, 9 to 4.
Yeah, and I wouldn't be doing webinars like this without it. So, Andrew, in regards to pulling out equity from a new property after 3 to 6 months, how do you buy it under market value when the banks will argue that the purchase price of what you paid for it is market value? They will, but you need to base it on recent sales and other properties currently on the market. So I use a lot of data when purchasing a property to make sure that I'm looking at all the recent sales, properties currently in the street, and looking at it from the eyes of the valuer. So you need to always put yourself, as I said, when buying the properties and getting the debt, you need to think about what the bank will take on from a debt perspective and get a debt strategy built around that and purchase the assets based upon that. When looking for the value of the property, I always put myself in the eyes of the valuer and look at it from all their perspectives and use the same data that they would be using. So recent sales, other properties currently in the market. If 5 houses in the street are sold for 300 grand, you're picking one up for 200 grand and has all the same specs, then there's a good chance that the banks will use those other properties as comparable to value the value of your one from. So you need to look at all that data when buying and building the asset base out. Hi, I want to talk to you both regarding loan structure and investing. I will get some contact details for Rose shortly at the end. We're not there yet. We've got some more slides to go through, so I'll get that. And yeah, let's just move on to the next one. Whoops, that's not what we're looking at. how to finance a 10+ property portfolio in 2021. I did talk about this in a previous event, so I'd probably suggest everybody, if you haven't watched last month's webinar, to reach out to my team and get access to that webinar, as it was really, really exciting. I noticed probably the highest amount of viewers ever on a webinar that month, talking about how to get a 10+ property portfolio in 2021. However, from a finance perspective, there's things that you need to factor in when building out the portfolio. So the first one is, where's the deposit going to come from? The second one is, how am I going to get the loans from the bank? Which bank's going to give me the loans? Right? And what we want to do is make sure that we're making ourselves the most attractive to the banks in order to get the loans so we can reach our goals of our properties. As I said, like in 2020, we've seen the largest amount of people getting to double-digit portfolio ever. And actually, I had the quickest portfolio I've ever built. So there was my portfolio, which was cool to start off with. Then there was Daniel's portfolio that we built. Daniel built his portfolio out. Then with Linda in our office, we got her sort of 10 properties in 6 months and got her 20 properties in like 12, 18 months. Actually spoke to someone in December for the first time, and I got into 15 properties already. Right, that's one of the portfolios.
I saw, I saw lately. There's a lot buying like 3 properties, and
Denisha is doing the loans. Denisha is one of our brokers here. Denisha's done all the loans, and out of that 15 properties, one of them is a block of 5. So that would technically be another 4 doors if you wanted to add it in. So it'd be 19 properties in 3 months. So yeah, it all comes down to structuring the debt. Getting the right asset is one part of it, but structuring the debt correctly so we can go back quickly, pull out equity. Even though the banks haven't relaxed the sort of lending out there, which we will hopefully see in the month of March when they pass the bill and to remove all the responsible lending laws, we have seen people going out and buying properties and being able to pull out equity within a month, 2 months, 3 months, 4 months. And it does become very tiresome for the team because, when you're buying a property, you might have 1 property or you might have 5, but you have to go back and reassess everything, right? You've got all 5 rental statements coming through, you've got the pay slips coming through. So it is a process, but we try and speed it up as quick as possible. And most of our investors go back and they settle on a property, and then a month later, 2 months later, we're pulling out an equity. We can never guarantee equity. We can only work with what the banks have. But if you're buying the property well, and it is below market value, you can pull that equity out. So if you've got 50 grand or 100 grand to start with, or even 30 grand, we've got that one guy where we bought him 3 properties. He had 28 grand to start off with. And he bought the first property, pulled the equity out, went back, bought the second property, pulled the equity out. The third property's going through at the moment. I need to speak to him actually. But yeah, it's important to make sure that you're keeping the banks happy and definitely achievable. I've seen more access to more people doing this in the last year than ever.
And also, like as I said, the bank is very generous at the moment with the interest rate. Like they can heavily discount it, so that means like servicing wise, can build you with more properties because you can obviously service. You can get more loans, and not only that, there's an easy way now as well in terms of providing documents and like bankstatement.com, and some of the lenders it's called open banking, right? Or you don't even need to provide, you can just access it.
Yeah, wow.
Yeah.
So that's the scary part, is when the banks access all your data, when every commie agency out there, like all the government, when I say commies, I'm talking about the government, all their agencies have access to your data, and having something like a mark of the beast sort of style crypto fake currency, which would be like a Aussie dollar coin or a US dollar coin or whatever the case may be, they have access to all that data. And it's interesting that at the time that that APRA came out and put all the responsible lending in, tightened up the lending criteria out there, they introduced open banking and open data between every government agency. So it's all digital. So yeah. Don't know what the last question is, comment, but yeah, we'll get to the questions shortly. Any other feedback or thoughts on how to build a property portfolio of 10 in 2021? Definitely, there's more people out there doing it this year than last year, more specifically than ever.
I think 2021 is a business year.
What's
it's
that? 2021.
yeah.
So I've just seen a message here. How much increase would be serviceability at back of relaxed responsible lending laws? Will it be like back in 2010 to 2012? Well, we've got to look at that, and if they do wind it back, it will take us back to 2015, which was the peak of the market. And the reason why it hit a peak, I believe, that they put in responsible lending laws to try and cool the market, because they were not able to do the interest rate rise. If they did, people would be in a lot of trouble. So yeah, and with the one last thing as well is with the debt out there, just back on the interest rate, will interest rates be rising? We've got a question, right? Like the amount of debt that has been taken up in the last year, right? There's been money creation. Money creation is not money, it's money, but it's not currency. It's currency, sorry, but it's not money, right?
Yeah.
The amount of currency that they're printing out there now, they've printed more debt in a year than what they ever had previously. The currency we use is a debt-based fiat Ponzi scheme, right? Because it's launched by the central banks. They print the money from the central banks, and you have to pay interest. So if the RBA was to print $1 trillion today, they're charging you interest for it.
At 0.10.
0.10. The reason why interest rates can't go up is because you have to find that money, which you can't find the money because they don't make it, because the central bank would have to print more money to give you the pay for it, right? So we're getting to the death phase of our currency, being the dollar that we've got. Looking at the level of currency out there and the level of debt, the government has, just in Australia, the government has taken out $1 trillion worth of stimulus packages last year. If the interest rates went up by 1%, that would bankrupt the government too.
Yeah.
Everyone would be bankrupt. So we're stuck at this point where interest rates are suppressed, and if interest rates and mortgages went up by 1%, a lot of people will be in trouble. If it goes up from 2% interest rate to 3%, or if it goes up from 2% to 4% interest rates at the consumer level, then a lot of people will be in trouble because they've just gone on a spending splurge. Right?
Can I ask you something? With it, for example, the interest rate now it's a 0.10, or if it can go negative, how does it impact the pensioners?
Well, they're in trouble.
Yeah,
They're in trouble. So it's a fraudulent system that we're in. Like it's
the self-liquidating pensioners. They have money in the banks.
Well, that's the problem.
It doesn't bear any interest rate.
That's the problem. That's why I think a part of it has to happen, because we've got the baby boomers, right? If they get ourselves in a position where they've got too much cash and too much shares, and we can't support. We know that we've got a problem with the aging population. So that's a whole other topic. But savers are losers. Like it's not even the fact that you're not getting money, not getting a return on your money. It's not the fact that even if you get 2%, right? It's the level of inflation that's out there that's the problem, because they're printing so much money. If you sell something, it's like, I don't want that. It's like if I have this cup and pretend I've got cordial in it, I pour more water into it. Eventually, you just keep pouring water into it, it dilutes any cordial in it. So you're diluting the value of the currency. So last year, if you had $1,000 in the bank, you could have bought cheeseburgers at half the price of what they're selling for now. So you can only buy half the amount of whatever you can. So it's a silent tax. And inflation's a tremendous thing, because if you've got debt, the debt becomes relevant with inflation. So you can pay off today's debt with tomorrow's dollar. That's the coolest part.
A loaf of bread, how much will it cost?
Well, we've seen Weimar Germany back in the roaring 20s of 1920s. So it's great. So that's the most exciting part, is where I can pay off that debt. 100 grand or 200 grand or 300 grand is not what that used to be in the past. Like, and the fact is that the cost of that money is so cheap because they've lowered the rate so much, they've manipulated it, which is great.
And your debt still remains the same.
Exactly, you're paying off today's debt with tomorrow's dollar. So how can Zinger help everyone here?
Well, keep in touch, and we have an email address that you can send us your details. And
we've got questions and answers, but we'll go to the next one. But if you do want to catch up with Rose, all the team, we've got. We actually just had to chop our office sort of in half and send some of our staff out because we're growing so quickly. So you got 2 or 3 more staff starting shortly?
On Monday.
How many?
2.
2 more?
Potentially another one. Could be 3.
Yeah. I actually had 2 more candidates. We can't keep up with the amount of demand. So
yes, busy.
I've got a team. Most of our brokers have been here for like 5, 7, 8 years. Rose heads them up, which Rose has only been here for a short period of time, like only a year, but she's done great with building my portfolio. So I wanted to make sure that people go, what makes you so special, Nathan? Why do you have 200 properties? Why do you have 230 properties? And it comes down to the financing. I'd love to see I'm so great because I buy all these properties, it's cheap, but the financing of it's what's important, and having the right team around you that can finance that. Rose has been by my side for half my life almost, so that's I'll look at it that way. Sorry to make you.
I was only 2 years older when I did it all.
That's it. So yeah, if you do want help on reviewing your strategy, reviewing your finances, tweaking it, seeing how you can push yourself to reach your goals, then reach out. The email address is here, info@zingerfinance.com.au. On that note, let's go to some of your questions, and maybe we'll answer like 5 to 10 questions, time permitting. Matt said he's currently dealing with Kabir. Kabir is awesome. I think Kabir's been with us for about 7 years now. So he's one of my senior brokers. Would you still think that the bottom end of the metro property market, Mount Druitt, with high rental yields and low socioeconomic, worth the hassle to consider it as a vehicle to financial freedom?
Mount Druitt is the North Shore of the West, no?
Yeah, I was about to say that. Mount Druitt's not the bottom of the pool, right? There's some areas that are much better, that I believe much better sort of place in Mount Druitt that would be in Sydney. They would have similar sort of prices. Mount Druitt's had so much infrastructure poured in, and it's picked up a lot of immigration to it. A lot of infrastructure from metro lines that go through. They're putting the metro line through St Mary's soon. So, yeah, they've actually bought up
so fast, that metro.
Yeah. So you could go from the city all the way through to Mount Druitt, all the way out into the new airport. So there is location still in Australia, which I've seen almost double in the last 12 months, which are other capital cities. So you can buy in Sydney still in 2021 for 250 grand.
Oakley.
That's right.
Oakley, is it?
No.
That's west on Druitt, Oakley.
Oh, Oakhurst. No, that's
Oakhurst.
Oakhurst is like $1 million now. So,
wow.
But
Hassel Grove.
Hassel Grove still like getting up there like 800 grand, those sort of areas. But there's areas in Sydney you can pick up for 240. We did a deal the other day for someone actually in here, 242 grand in Sydney for a property. And no, it's not a shipping container, it's an actual property. There's in Brisbane, I'm picking up for 110, 120, 150 in Brisbane. Got a question here, is it a house or unit? I just picked up a house in Brisbane for 220,000 for someone. So you can still get houses in capital cities. Houses in Perth for 200 grand. Units in the heart of Perth, in the CBD of Perth, for 120, $140,000. These things used to sell for a lot more. There is a lot of emerging markets out there in the country, which I'm not going to go into too deep because that's my intellectual property, and that's how I help people build their large property portfolios, 10, 15, 20 properties. So, and thinking about it, right, if you can buy a property for $150,000, that rents for $250, $300 a week, you know, most people out there trying to buy a house for 800 grand that they have to pay the mortgage themselves, or they might be buying a property for 800 grand that rents for 500, 600 bucks a week with some potential development or whatever. If you can go and buy 10 properties for 150 grand, it's only $1.5 million, but that's getting you 300 bucks a week times 10, that's 3 grand a week, it's 150 grand a year. So your cash flow is improving and it's helping out with your finance, and then you can go back and borrow more money. How do you find acquiring properties competing with other buyers agencies? They're not really a competitor. They don't know what to look for. They don't have the contacts. They've got 27,000.
They don't have your expertise.
They don't have my expertise. So it's, yeah, that's why I get the properties that are so cheap and below market value. Most of your deals before they hit the market, have you secured anything worthwhile that wasn't off market? Probably half the properties will be on market and half of them will be off market. I've got a lot of agents that, whether they like it or not, when I think about it, right, and you look at all these vested interests that are out there in the market, like whether it be vested interests in the media or vested interests in the banks or vested interests with whatever, or in politics, vested interests, I actually think about it, and it's the first time I've thought about it when I saw this question, is that I'm the vested interest in property, right? These agents, I've built a lot of their careers. I've had agents that have been #1 performers, and you look at them, it's like these guys can't even tie their shoelace together. That's why they got the slip-on shoes. But no, they can't.
They meet their target.
Because they meet their target. And why do they become successful with their career? Because Nathan Birch bought all their properties. So I have agents that are out there that they'll tell you to go away because I've got the property under wraps. And yeah, that's the relationships that I've built over the years, is being able to control the market and control the deals and control the deal flow. So maybe that may be just due to the scale of size as being able to do that. So when are you doing another Koshi interview with Koshi on Sunrise? You couldn't pay me to do an interview with Koshi, right? Those guys have got product placement and certain things going on with that show. It's a rigged game. It's a rigged game with those guys. That guy there, good luck to him. He's still waking up at 3 o'clock in the morning, still miserable, looks miserable when you see him, sounds miserable, and still got massive opinions. So, yeah, and people may not know what we're referring to. Going back about 7 years ago, actually, it's a fun little story.
So do you feel like you've been ambushed?
Yeah, I ambushed, right? Because I've got different agendas than what the media have and their advertisers have. So I get ambushed in the media. I used to be loved by the media, and they still do, right? And a lot of my investors, some of my investors are actually very senior in the media too. So I'm always welcome on that. However, it's Koshi came on this morning and he had an agenda, and he didn't like me because he's sort of opposite to what I do and all that. And he interrogated one of our staff, Linda. Linda's my general manager here at B.Invested, and she was on the show talking about how she bought 20 properties back in the day. And Linda came with no silver spoon in her mouth, and her and her husband worked very hard, and they built a property portfolio of 20 properties. And she lives in a castle nowadays, Linda, right? She's just an average family, average mum and dad. And Koshi came on and tried to make her look like an idiot. And she didn't know what to say because she'd never been on TV, and it was live TV. Yeah. And he's like, aren't you scared with all this debt? And he was being a dick to her. And I actually spoke to Linda recently. I said, what do you want to do in 5 years? And we'll go for a drive. We drove to Queensland. And she goes, oh, I want to retire. I was like, how are you going to retire? And she goes, I don't know. You tell me, Nathan. And I said, well, what we'll do is we'll sell off your house that you live in now. We'll pay out all of your debt. And then you can buy a house cash in Noosa, and then you'll have your whole property portfolio outright and your house. She goes, let's do it. But one thing I do know is that Koshi still lives in a certain property where I know people that live in that property, right? He's still getting up in that morning, and he's still making very bad investment advice and decisions, which if he was not owned by certain entities, he would be giving bad financial advice live.
He's a financial advisor by trade, isn't he?
Can you say some of the things that come out of his mouth? Because I remember hearing him say to people to sell their houses and sell all this stuff and buy shares 2 weeks before the GFC and the stock market dropped by 30 to 40%. Yeah. So you know, it's funny. So it's he's still blogging his books at Big W. Yes, he is. You know, that's the best he can do and make it in life. And someone just wrote in, do you think Martin North will finally buy a property? He must be tired of house sharing with Stephen Keane. That is one miserable person, that guy. And I do believe some of his thoughts and his philosophies, but the guy has given so much bad financial advice. There's all these people out there giving this financial advice, showing that they're experts, and he is one of them, which has told everyone all these things are going to crash and burn. And he actually said that I was full of shit, and snipped out 20 seconds of a video where I said interest rates are zero, which they practically are, and that you can't go bankrupt because they've put the house, the mortgage moratoriums onto the properties, and the guy's miserable, still giving the same negative advice. So yeah. There's a lot of commentary on everyone on numbers of properties, i.e. 2% of investors have more than 6 properties. What about info on dollar value of the portfolio? What is the value of portfolio or 98% mass? So good question. So as an investor, you know, most people can only go to the banks. That's why finance is so important, and be able to purchase sort of 600 grand, 700 grand, 800 grand properties. And that's why house prices sort of hit a peak in most of the bread and butter, blue and white collar areas of cities, is due to the amount of money that their income can service for. So if the market was to double, the way that I see this, if the market was to double, would you want to take an 800 grand property and double it to 1.6, or would you want to take a $5 million property portfolio and double it to 10 million? Given the fact that if you could take that 5 million and double it, you could take some of the profits, sell off a couple of the properties and pay out the remainder of the debt. So as an investor, I want to have the largest asset base. I talk about property investing as a vehicle. My business is called B.Invested because I'm investing into whatever it is, whether it be people, business, properties, cryptocurrencies, infrastructure, commodities. You know, I invest into things. As our investors, you know, build out their wealth, we want to see that they're generating income streams. So it's important to view what is the end goal and work backwards. How many properties do you need? So if you had 7 properties that were owned outright, the reason why I think it's so important to have, you know, certain numbers is 7 properties at $300 a week. 7 times 300 is 2,100. 2,100 a week times 52 weeks in the year is about 109,200, if my calculation serves me correctly. So if you wanted to replace an income stream of 100 grand a year, you would need about 6 or 7 properties owned outright. So that's where the cool part starts, by doing that. So it's not about a number of houses or units, it's about having a net worth position and having a cash flow position that's going to support your lifestyle so you can do what you want, when you want, how you want. So yeah. Lots of questions coming through. I can notice that we're running a bit short on time as well. Nathan, what are the plans for the recent pub repo purchase in regional Queensland? Will you reopen the bottle shop? If so, I'll come and grab some beers. Yes, so I just bought 7 motels recently in 2021. Those motels I had to buy cash because I haven't got loans for them, so I'm settling them cash, and then I'll build a hotel group out of that. So most of them have been like sort of between 12 and 32 room motels with kitchens and function areas and stuff like that. One of them was a pub that I bought. I stole the pub for 100 grand. The owner previously paid 500 grand for the pub. I bought it for 100 grand. It's got a bottle shop, 12 motel rooms, and a pub. I don't know anything about pubs, but you know, people run them. People that are, you know, don't have as much resource as what we've got here in our community. And we're building the Birch Hotel Group, which will be rolling out very shortly. And the pub will be operating, the bottle shop will be operating, the accommodation will be operating. Just don't ask me how long it'll take, because you know, liquor licenses and all that sort of stuff. So it's going to be you know, fun along the way. So yeah. I'm going to stop answering questions based on that. There's a couple here that, a few rows. The if you have a standard variable interest rate on an interest-only loan, can you reduce your rate or do you have to refinance?
You can, as I said previously, you can negotiate the interest rate within the bank that you're in. But as I said, how much can they reduce? I'm not sure, because from the experience, you're not a new money. They don't reduce as much as when you go to another lender. We can better off getting a better pricing approval. So we can also always do a comparison as to how much they can reduce your rate and how much we can offer from how much the offer from the other lender.
Cool. William asks, do you also provide support for those wanting to get into commercial real estate or just residential? Last year we bought some shops, right?
Yeah.
Which are in Western Sydney. You buy a shop and a one-bedroom unit, brand new, for 320,000 plus GST, and they came in at, can I talk about what they valued up at? They valued in at almost $600,000. So it's like you're buying one property and you're getting one for free. So you bought a unit, one-bedroom unit for 320, you get a free shop. There's one example recently. I do large blocks of units. As I said just beforehand, I buy motels, I buy shops. You know, it depends what's the strategy though. So as I said beforehand, you know, the property becomes a vehicle to get the debt and to build out the asset base. If you could have $1 million in shops, which has got a higher risk, that's what the banks require. What deposit does the bank require?
For commercial?
Yeah.
Could be like 40%, 30%?
30%, 40%. The banks see it as a higher risk. So if you had $1 million worth of commercial property, which has a higher risk attached to it, or a $2 million worth of residential property, if they both doubled, which one would you be better off with? So looking at the outcome of what you want is more important than the actual property. If you want commercial property and you think it's going to be the holy grail to get there, I can help you with that. However, I don't just buy properties for people for the sake of buying the properties. It's the overall holistic strategy. Because I'm not going to be, you know, here helping people hurt themselves financially. So, what is the best interest rate you can get from the Big Four? Investment / interest only. Should I search in Rate Finder?
Well, it depends on the volume of the loan. If you have, like, say, close to $1 million, you probably be able, this is interest only with interest only repayments for investment, you probably be able to get 3%.
3%, yeah, cool. And what about if you're owner occupied?
Oh, owner occupied, you can go up to 2.5, 2.4.
You actually just got one for me, I think, for 2.4 or something for me personally for an owner occupied. Cool. So on that note,
that is variable rate though.
Variable, yeah. If you fix them, you can get 1.99.
1.99, but it's fixed for 4 years, or
yeah. And if the bank's going to fix it for 4 years for 1.99, that's cheaper than the variable. There's a good chance that, you know, we're going to see them come down lower because the bank's taking a bet on you. So just to answer the will interest rates go down or go up? Yeah. Luke just said, fabulous content tonight, Nathan Rose. Really enjoyed watching and learning from you rather than watching Married at First Sight. So yeah, it's you know, those shows are there to distract, and you know, the level of, you know, intelligence can be gained from what you consume and whatnot. So thanks a lot for everybody for watching. Yeah, if you do want some help regarding finance, email the team at info@zingerfinance.com.au as per this slide here. Booking for a finance review, financial strategy review. So yeah, if you have a loan, make sure you speak to the team. If you're thinking of getting a loan, make sure you speak to the team. If there's anyone out there, you know, a friend, a colleague, you know, a family member, a parent, a child, whatever, that is in a position that needs help, feel free to reach out to the team. And the team are very you know, educated and skilled in being able to help tricky situations. I like to refer to the brokers here as finance strategists rather than just a mortgage broker because of the level of intellect and knowledge and resources and skill that they've got in building these large
and the experience that we have.
Yeah. So cool. Thanks a lot, guys and girls.
Thank you. Good night.
Catch up soon. Stay safe, everyone. Bye for now.
Bye.